Today's interview is brought to you by YCharts. For a free trial and 15% off your subscription, go to go.ycharts.com/forward-guidance. Very happy to welcome to Forward Guidance Dave Rosenberg of Rosenberg Research. Dave, great to have you on Forward Guidance at last. Welcome.
Well, it's great to be on, and I love the term forward guidance since we have a central bank and a consensus that loves to look at backward-looking data. So forward guidance it is.
Backward-looking data, but they do like to give a little hint every now and then about what is to come for interest rates. Did you glean anything from last week's Jay Powell's speech at Jackson Hole about what might be to come? More rate hikes, potential for cuts in 2024? What did you think?
Well, I think that we're at a far different place today than we were a year ago when the funds rate was considerably lower than it is today. And Jay Powell was talking about having to inflict pain on the household and business sector. But I think that right now, I mean, we could debate if they're going to raise rates again in November. The market is, basically 50-50 on that. I don't think they're going in September, and the market's not really priced for it. So they either go in November. I believe the meeting's November the 1st. It seems like a lifetime away. They'll be data dependent. I'm thinking that the data will not play ball for another rate hike, but this is actually the tightest Fed policy we've had since the Volcker period in 1981. So you and there's people on the Fed that still want to raise rates. So he's got to walk a fine line now that there's some division. Obviously, you have Goolsbee and you have Harker on one side. Let's pause. You have Messer and Collins. No, let's keep on going. So there's a chance, obviously, they can go one more time, but I don't know if that's the really big story. The really big story is what happens next year. The story behind what happened with the bond market in the past couple of months really was about the reset of Fed expectations. The Fed, if you go back a few months after Silicon Valley Bank and some of the other ones that failed, we were supposed to get rate cuts, starting in the fourth quarter. That's not going to be happening. So the question is whether or not, even though the market's priced has pushed out the Fed rate cuts for next year, they haven't totally abandoned the view that the Fed will be cutting rates next year. And so the Fed's got this mantra right now: higher for longer, higher for longer, higher for longer. But then again, we're just about to finish August, head into September, and even 2024 right now is a long ways away. So the market stubbornly thinks that the Fed has overdone it. They'll be forced to cut rates. So the question is really going to be, will the Fed do less, more, or the same as what the market's got priced in right now? That's what's most important. Whether or not they move one more time, to me, that's just, noise at this particular point in time.
So you said that you don't think the economic data will play ball. I think this is until November. What did you mean by that? And then, where do you think the economic data will be in next year, where cuts could be on the table?
What we don't know is, what does the American consumer really look like when we don't have the full impact of these stimulus checks that were mailed out a couple of years ago, over $2 trillion, but it was a gift that kept on giving. And this is where I went awry in my own forecast, was because I was superimposing the historical record as to how do consumers behave when they get free money from the government. And historically, they save half and they spend half. I was thinking that they might even save more than half, because 2/3 of American households went into the pandemic without enough savings to get by 3 months of vital economic activity. And here we were locked down. I thought that was going to be a memory that would be seared on the proletariat. But what I failed to take into account was YOLO. You only live once. FOMO to the equity market is YOLO to Main Street. Anger spending. And so what happened is that every penny of the stimulus checks got spent. But what I'm saying is that the San Francisco Fed and they put out the best research. Wrote a report last month showing that the last vestiges of the Energizer Bunny, otherwise known as the Biden budget buster from that stimulus checks to everybody, that basically expires the impact at the end of September. And of course, what we know about September is that that's the same month where, and look, we've had this in place for a while, the debt service relief plan. And so all of a sudden, all that money that would have been spent on fun and games among the young people who spend, who have a very high spending propensity, well, now they're going to be siphoning that into servicing their debt. So, I know everybody talks about, that we have the onshoring phenomenon, the CHIPS Act, the anti-inflation, the Inflation Reduction Act, all these subsidies and so on and so forth, and capital formation for manufacturing. I mean, you amortize that over a long period of time. Infrastructure spending, or the sort of stuff people talk about that's providing juice to GDP. It's like talking about FDR's New Deal in the 1930s. And the New Deal was a funky deal, and we built a lot of bridges and transportation networks and dams and highways and theme parks. But it wasn't FDR's industrial policy that ended the Great Depression. It was World War II. So these people that talk about fiscal stimulus in the way of the industrial policy, you have to amortize that impact over at least a decade. But for the here and now, in terms of what it means for the consumer, that's top of mind. What happens now that all the stimulus is worn out, and wearing out at a time when jobs are not declining, but the pace of job creation is slowing? And you usually go from strong labor market to cool and then to cold. And what's really top of mind for me, I know the first question was about Jackson Hole last week. That was the big event of the week. But really, was that the big event of the week? Or was what the retailers told us last week the big event of the week? Was what Macy's had to say, and Kohl's, and Lowe's, and Foot Locker, Nordstrom, all of them. Weak sales, weak traffic, consumers trading down, and very downbeat guidance. And on top of that, a surge in consumer credit card delinquencies. And that's really important, because you're starting to see that the banks are tightening up their standards for credit cards like it's nobody's business. At a time when people are applying for more credit cards, the banks are rejecting the applications. And that was responsible. We talked about the student loan program. That was important. We talked about the stimulus checks and the lagged impact that had. That is really what's thwarted so far the Fed's efforts to rein in aggregate demand. But that's coming to an end. But you see, even as those stimulus checks for many people were already being terminated in the past year, not for everybody, but for a lot of people, what were they doing as an antidote? They were tapping their credit cards like it was nobody's business. 20% of the growth in consumer spending in the past year came from the credit card. So all these things are going to be changing in the next couple of months. And I think we will not be talking about consumer resilience anymore. When people say to me, what will we be talking about in the next few months? I just say, I'll tell you what we will not be talking about. We will no longer be talking about consumer resilience. That's 70% of aggregate demand. And as that weakens in the next several months and quarters, the Fed is not going to have a choice but to go on hold, and then invariably interest rates are cyclical. I don't know what the pushback is, what this whole thing about higher for longer is. The higher for longer thesis would tell you that interest rates aren't cyclical, which is ridiculous. Interest rates are cyclical, and they will move with the economy. So this notion higher for longer, that doesn't play in Peoria as far as I'm concerned. It's a nice little refrain, because the Fed doesn't want the markets to get ahead of themselves, but the Fed will be cutting rates next year, or maybe even by the end of this year. I still think that's the principal risk.
The logic behind higher for longer, I think, is that the economy is very hot. And so if the economy is slowing down from a very high level of nominal GDP growth, then a slowdown from 9% nominal growth to 7% nominal growth, that's still 7% nominal growth. How much do you think the economy is going to slow down if we're just talking about growth?
Look, we could have been talking about, it reminds me of We could have been talking about the same 7% nominal growth in the summer of 2008. When oil prices were $150, and we were talking about global decoupling, which was ridiculous, and the Chinese super cycle. And back then, higher for longer, if you remember, was about commodities. We're in a secular uptrend in commodities. So higher for longer, you could have applied with your nominal GDP growth. The question is not where is nominal GDP growth today. The question is where's it going to be a year from now? Where's it going to be 2 years from now? Now, this is just called fun with figures, but once again, the San Francisco Fed, I think I mentioned it before, they are the best Fed when it comes to research.
Maybe not bank regulation, but when it comes to research, yeah.
Top dog, yeah. Well, okay, we can talk about leadership another time, but top dog when it comes to research. And they traced out the lags of the rental components of the CPI. What else do you need to know if you want to try and forecast oil or forecast food? But over 30% of the CPI are the rental components. 40% of the core are the rental components. So you get the rental components right, and everything else will fall into place. Now, we already know in real time from whatever data you want to look at. I look at the apartment list rental data, and seasonally adjusted, they've been deflating now for months on a month-over-month basis, and the year-over-year has actually gone slightly below zero. But because the CPI includes all the lags from the leases that were signed 12 and 24, 36 months ago, it lags in both directions. If you remember that when all the inflationists came out, and they were right a few years ago, the rental components were still extremely low and were providing this false glow of low inflation. Next thing you know, we had 9% inflation in the summer of 2022. And now in the opposite direction, inflation is staying artificially high because of these rental components, but they haven't fully matched what's happening in reality. But at some point, the previous leases fall out of the CPI data, and the deflation that we've been seeing for the past several months will show more forcefully in the future data. So the San Fran Fed tells us something very important, which is that by this time next year, the rental components, 30% of the CPI, are going to be either zero year over year or fractionally negative. So if you just basically take the prevailing trend in non-rental inflation from the CPI and you just assume it does nothing, and we could argue, what does food do? What does energy do? Let's just say that we just stay in the range of the stuff that is non-rent. Inflation is going to be well below 1% this time next year. So if inflation is going to be less than 1%, how does nominal GDP growth stay at 7% unless you think real GDP is going to be 6%?
Well, the Atlanta Fed thinks real GDP is going to be 6%.
Yeah,
5.8, I think.
So real GDP might be like close to zero, and you could have inflation at 1%. You could have nominal GDP down to 1%. So all these people that say today, oh, well, look where bond yields are relative to nominal GDP. But all these markets are forward looking. Your show's called Forward Guidance. So the problem with forward guidance and talking about nominal GDP is nominal GDP, if you're talking about today, is a 4-quarter trailing trend. The question is, where's that 4-quarter trailing trend going in the next year? And it's going to be sharply lower. It's going to catch a lot of people by surprise.
Can you opine on the Atlanta Fed nowcast? I think for third quarter GDP is going to be 5.8%, 5.9% for real GDP. How do you think that they arrived at that figure? Why do you disagree with it? I presume you disagree with it. And then there's another Fed model that you, I think, probably think is more accurate.
What the Atlanta Fed does is they take the most recent numbers and they superimpose. So they'll superimpose July and August into September. So we had that ripping number, the 0.7 on retail sales. And that was when they really took their numbers up. But we're going to be up 0.7, 0.7, 0.7. And by the way, I question that 0.7 because what's interesting is that the raw data, the non-seasonally smooth data for June and July was the weakest we've had in the past 5 years. It was a very aggressive seasonal factor, but the Atlanta Fed is just basically robotic, automated, and it just builds in an assumption that what you see in 1 month, you'll get the next 2 months. The last time we had Atlanta Fed this high a couple of years ago, I was calling for 6% growth. I forget exactly which quarter it was. We ended up with 2%. So I think people look maybe a little too closely at Atlanta Fed, and it could be a bit of a tripwire here. The St. Louis Fed, which you talked about, is at 0.5, and just a different methodology. But it's a 0.5. Atlanta Fed is at almost 6, as you mentioned. But where's the consensus of economists? Because the consensus of economists, they're not robots. They're not machines. And the economists are obviously knowing that the 0.7 for July in retail sales was a bit of an outlier and not likely to be repeated. The consensus, I think, for third quarter is 1.7. You got a massive discrepancy. A lot of people like to focus on Atlanta Fed. What they don't realize is that at this stage of the cycle, towards when the final numbers come out, it's going to be completely different. But you see, Atlanta Fed got it right last time around. We got 2.4 for second quarter. They nailed 2.4. So therefore, Atlanta Fed must know what's going on. But I think there's a danger in extrapolating these numbers, especially when we know that we are getting hit with downward revisions to the employment data, right? Like, again, we talk about Jackson Hole last week. I talked about, to me, the big news was what the retailers had to say, not just about their numbers, but about their outlook. But here we had, the census numbers, the CQEW data coming out showing that employment in the year to March of this year was revised down 306,000. And so what that's telling you about revisions, what it's telling you about revisions to income and production, that employment was actually a lot weaker. I'm looking at the data. We're getting a fresh non-farm payroll number at the end of this week. And everybody will be trading off the number. Everybody will be talking about the number. And it's a fictitious number in the sense that it might be all we've got right now, but non-farm payrolls have been revised lower each month this year. Every month this year, non-farm payrolls have been revised down by a cumulative 278,000. That's almost 50,000 a month. And everybody's going to be trading off non-farm payrolls like it's the holy grail. But we are seeing steady downward revisions. It comes to, your comment before about the economy is hot. I'm not so sure. I'm not so sure it's as hot as a lot of people think it is. And I'll tell you right now, how could it really be hot when you're taking a look at what the retailers had to say about volumes, foot traffic, sales, and trading down. The reason why the dollar stores, say in Walmart, are grabbing market share is because even wealthy people and rich people are going to areas that have more promotions and discounts and lower prices. So there's a real shift as well towards trading down. I don't know how you build an inflation scenario out of that. I'm looking at the bank data. You got bank deposits negative year on year, bank assets negative year on year. The banks are getting smaller. And they're tightening credit in a credit-driven economy. And we're supposed to squeeze inflation out of that. How?
I guess the one thing that's remaining is low unemployment rate, 3.5%. If 96, let's call it 97% of people who want a job have one, so pretty much everyone can get a job. You can spend money. You can go buy that thing. And so you don't curtail spending.
Well, look, it's interesting. We talked before at the outset about the forward guidance, which I love the term of your show. What's the Fed focused on? The Fed is focused on service sector inflation. It's in the Conference Board's index of lagging economic indicators. The Fed's focused on the unemployment rate. You're right, 3.5%. It's in the index of lagging economic indicators. And so that's why we have a Fed focusing on contemporaneous or lagging indicators. They obviously have no faith in their models and they have no faith in their forecasts. They're focused on things that lag the cycle. The unemployment rate is always the last thing to go up. The recession causes the rise in unemployment. The rise in unemployment does not cause the recession. The recession causes the rise in unemployment. And it's not unusual to have the unemployment rate only begin to rise well after the recession's actually already started.
Can I ask you, so what causes a recession? A seemingly simple question, but one is super hard to answer, I know.
It's when the economic agents, face some sort of a negative exogenous shock. So the shock has been interest rates. Interest rates. The power of compound interest works in both directions for savers and borrowers, but as maybe the best economist of all time was a Nobel laureate physicist, otherwise known as Albert Einstein, who famously says that the power of compound interest is the eighth wonder of the world. We've had the biggest interest rate shock since 1981. If I'm not mistaken, 1981 was followed by 1982, which was not a mild recession, by the way. So we've had an interest rate shock that so far, part of that impact's been blunted by the lingering impact of the fiscal stimulus, which is now in the rearview mirror. So when Jay Powell said at Jackson Hole a year ago he was going to inflict pain on households and businesses, for anyone who wants to be in the market for a car, the financing costs are way too high, can't afford it. Anyone wants to go out and buy a home, the housing market is in the complete doldrums, especially in the resale market. So that's how the recession takes hold in those particular sectors. Look in the business sector, for example. In the business sector, what happens when your financing rates go up as much as they have? So your hurdle rate for new capital projects has been influenced dramatically by the higher. You have to discount. You have to look at your a priori expected rate of return on new investment benchmarked against the cost of capital. That equation has changed. So it's totally clouded the outlook for capital investment. So this is a case of, for people that are in this no landing or soft landing camp, it's really a case of hope triumphing over experience. Or unless you think the business cycle has been repealed or interest rates don't matter. But you see, it usually takes 2 years from the time of the first rate hike to the recession. Now, it's true that not every Fed tightening cycle leads to a recession, but the three that did not lead to recession in the post-World War II period, which was in the mid-60s, the mid-80s, the mid-90s, the Fed did not keep tightening into an inverted yield curve. This Fed, who was shamed because it missed on the inflation and has spent so much time rebuilding its credibility, the bottom line has been that we have to take no prisoners and embark on one of the most regressive tightening cycles and continue to raise rates into the yield curve inversion.
Hey there, I want to tell you about YCharts. It's a state-of-the-art platform that helps you on every stage of your investing journey, from idea generation to portfolio construction to performance tracking. It's going to simplify your investment research process so you can act on an idea right when that light bulb flicks on. I use YCharts every day, not just to make charts to show and forward guidance, which I'm sure you've seen, but for fundamental research into macro and companies as well. For example, in March, I needed a crash course about the issues regional banks were having. You can probably imagine why. So I used the YCharts stock screener to find the cheapest regional banks with a variety of metrics, and that led me to the companies that were at the eye of the storm, and that helped me a huge amount. These are some of the ways I use YCharts, but I've only scratched the surface. If you're an investing pro, they've got much more powerful tools for you: scatter plots, time series analysis, report building, and client communication. I know YCharts well, and I like to think I know my audience well, so I know that there are a lot of people watching this right now who would benefit immensely from YCharts. Whether you're an individual investor or a professional in the wealth management business, whatever stage you're at, YCharts is going to help you get to the next level. So you really should check them out. Go to go.ycharts.com/forward-guidance. And by the way, if you click that link, we can get you a free trial. So at no cost, you take it out for a test drive, see if YCharts is a good fit for you. And what's more, if you're a new customer and you sign up, you can get 15% 15% off your initial subscription using that link, which again is go.ycharts.com/forward-guidance. Thanks for listening. Let's get back to the interview. Advocates for the no landing scenario would say maybe not that interest rates don't matter, but that this cycle is much, much less sensitive to interest rates for a variety of reasons. You alluded to one, that homeowners are locked in at that super low rate, as are, S&P 500 companies that issued tons of, investment grade debt for a very, very long term. Would you say that this economic cycle is somewhat less sensitive to interest rates, or that, compared to the 1980s when manufacturing which was mostly financed by bank loans, was a huge percentage of the economy, whereas now manufacturing is something like 20% of the economy, and a lot of companies finance themselves in the bond market, not sort of floating rate debt. Would you say it's somewhat less sensitive to interest rates than the 1980s, or the exact same?
Marginally. It's not. If you look at the interest sensitive share of the economy, marginally lower than it was 30 or 40 years ago. Certainly not enough of a difference to say there's no recession this time. You could have said, look, it was called the Great Recession. You could have made the same argument going into 08 and 09 that the share of manufacturing in the economy has never been this low before. Don't worry about it. And people were making that argument. And this is not going to be a repeat of 08 or 09. But I think that to say that the economy is interest insensitive because so many homeowners locked in, that's not where the recession starts, right? The recession starts because higher interest rates make it tougher for people to buy big ticket items. It makes it tougher to do almost everything that requires a loan. What it does is it basically induces people to save. You have now you can get 5 to 5.5% in T-bills or your money market account. Well, that's what the Fed wants. When the Fed's cutting rates, it wants people not to save, it wants people to spend. When it raises rates to these levels, they want people to save. So it's not a dynamic we had a couple of years ago. Look, everything got complicated by COVID, the response to COVID, all the stimulus related to COVID, and people's behavior. But I was saying before that, the fiscal stimulus of the past couple of years, and we're not talking about bricks and mortar or what they're talking about, manufacturing capacity and all this stuff. That does not influence the contours of the business cycle, okay? But when you give somebody free money, like the government was doing, and to such an extent, and we couldn't spend it all at once. So this was a gift that kept on giving right up until, well, like once again, I'll tip my hat to the San Fran Fed. That money is about to run out. So, we'll see. We'll put the thesis to the test. I think that the people in the no landing, soft landing camp had the fact that everybody spent all the stimulus, which is incredible. And then it kept on going right up until current day, which is also rather incredible. But then again, $2.2 trillion. You can't spend that all at once. And it had a two-year time span, rather incredible. But remember that the recession starts 2 years after the first rate hike, almost to a T. And the first rate hike was March 2022, which means that you got fourth quarter this year, first quarter next year with a bullet on its forehead. And we have to take into account the fact that, why are we seeing, like if the labor market is as strong as they say, you see, we put so much faith on the government numbers. We know now, after Macy's, Kohl's, Walmart, Target, all of them, Lowe's. We know that the 0.7% July retail sales that ripped the face off the bond market and everybody just joyous over like, this is like Brazilian economy. We're going to put stock in what what the retailers had to say, or what the government data showed for July. Seems to be a different picture, but I'm there talking about the fact that how is it that before, you talked about the unemployment rate, and you're correct, it's 3.5%. So why then are bank-wide consumer card delinquency rates have already taken out their pandemic recession highs in early 2020 when the economy was locked down. And we are at a 12-year, we're at a 11-year high. We're at the highest level since 2012 on consumer, and this was the linchpin for growth. The linchpin for growth is not the people. The people that borrowed, locked in their mortgage, they're basically irrelevant. They're neither a negative nor a positive, okay? But what about these people that are defaulting on their credit cards? And it's not just that, but also look at auto loans.
So those delinquencies on autos and cards are, as you say, above the 2019 level. And yeah, but delinquencies, they were secularly low after, over the past 10 years. Like, I think delinquencies now are lower than they were in 2003. So there's a lot of secular stuff going on. And isn't it fair to say that revolving consumer credit as a percentage of national income or percentage of personal income is actually quite low?
No, I don't think so at all.
Okay.
I'd like to see a chart on that. Total household debt to income only looks low relative to the bubble peak in the mid 2000s. Outside of that, it's above every other cyclical peak that we've had going back in the post World War II era. We had blowout consumer credit growth this cycle, especially in the past year. And auto loans, especially in subprime autos. So there's been outside of mortgages, a huge credit bubble in non-mortgage household lending in the past several years. The question I was going to say, you can talk about 2003, but in 2003, the unemployment rate was, call it, we were just coming out of the recession, and we were 6-7% unemployment. We got the highest credit card delinquency rates since 2012 when the unemployment rate was 8%. So what's it telling you? What's it telling you? Like, what happens when the unemployment rate goes to 4 and 4.5? The Fed wants it at 4.5. Maybe that's why the higher for longer, they're frustrated that they're not getting more slack in the labor market. You've already had these delinquency rates go up. And we're not talking about low numbers. These are you're talking over $1 trillion of debt. And this is what happens. This is what bankers see. So that's why, once again, what came out of the last round of bank earnings? They are radically boosting their loan loss provisioning.
From very low levels.
What does that mean? It means that we're going into some form of credit contraction. That's how you get a recession. That's why out of the 14 Fed rate hiking cycles since 1950, 11 of those were followed by an NBER-defined recession. And I said before, you had 3 soft landings, mid-60s, mid-80s, mid-90s, but the Fed stopped. The Fed stopped. They were not focused on lagging indicators, and they respected the shape of the yield curve. So we did not get recessions in those periods. Now, remember, I talked about the mid-80s. We skipped a recession, but when the Fed inverted the yield curve in 1989, we had a recession in 1990-91. We skipped a recession in the mid-60s, but the Fed inverted the yield curve in the late 60s, and we had a recession starting in December 1969. We had the mid-90s. Remember, in 94, 95, Greenspan's called Maestro. He raised rates from 3% to 6%, didn't invert the yield curve. Guess why? Because he respected market signals. And Greenspan, despite his faults, did not focus on lagging indicators. Now, he made his own mistakes, but be that as it may, when they did invert the yield curve in 2000, we had a recession starting in 2001. So I just find it very interesting that, you're talking to me about, well, the economy is less interest sensitive here and people locked in their mortgages there. And it's all this stuff that, let's just pretend the business cycle doesn't exist. I hear this. I mean, I've been doing this 40 years. I hear it every time. The United States is at its root a credit-driven economy. What happens in rate cycles in both directions, it influences the creation of credit. And you're seeing the early signs of it contracting, and it's going to continue because only now what's changed the most, admittedly, is not the unemployment rate. By the time you're watching the unemployment rate go up, it's too late. But the delinquency rates going up as much as they are in the context of 3.5% unemployment is telling you about all the reckless lending and borrowing behavior that took place this time. So we just replaced credit cards with what happened with subprime mortgages 15 years ago. And it's not going to be nearly as big a deal. And these things aren't wrapped in mezzanine CDOs and leveraged over and not in fictional AAA securities sold all over the world. However, this is how a recession starts. It starts with a significant erosion in credit quality in one particular asset class. And right now you're seeing it in credit cards, and it is not insignificant, even though it's not residential mortgages.
Yeah. And it kind of snuck out of nowhere because credit card delinquencies were so low in 2020 and 2021 that, from moving from 50 basis points to 80 basis points didn't seem like nothing. But yeah, now we're at, in aggregate, 2019 level highs. And I think there was a huge decline in borrowing in 2020 because government people relied on fiscal stimulus or other stuff. There was not a lot of demand for bank credit, so bank credit has been exploding higher, and so bank credit peaked last year in 2022. And alarmingly, I would agree with you definitely on this, that I think like loans and leases has been stagnant for the past 7 months, which is not a particularly good sign. I'd say it is an ominous sign for the economy.
Yeah. Look, on top of that, we have what's happening in commercial real estate. And then look at where C&I loans are going on bank balance sheets. They're contracting. So that's what I'm talking about. So people take a very myopic and what economists would call a partial equilibrium or static approach towards interest rates. And they say, well, don't worry, people locked in their mortgages. Oh, and you said earlier, don't worry, companies locked in. That's not what gets the recession started. What gets the recession started really is the impact it has on new spending. What is GDP? It's aggregate demand. It's about new spending, not old spending, new spending. So there's no way you're going to convince me that we're going to have the same spending profile at a 5.5% funds rate that we did when it was close to zero. How does that make any sense? Of course, the economy resets. The economy is a juggernaut. It's got $25 trillion juggernaut. It doesn't implode normally. Most recessions don't have it implode, but it's a gigantic battleship, okay? But it responds and resets to these higher rates. So we've had a massive interest rate shock. We have not seen the full impact yet. Part of this impact's been blunted by two things: student debt relief done, stimulus checks of over $2 trillion done. And this will be very interesting to see how all this plays out in the final few months of this year and in the next year as you're taking these props away. On top of that, we have China seemingly heading into some sort of recession, or certainly it's already entered into a structural slowdown. Now that's bumping up against a cyclical slowdown. And it is exporting its deflation to the rest of the world. In one statistic, in July, export prices in China were down 5.5% year over year. And their export prices are the import prices for everybody else in the world. They're deflating. They're exporting their deflation. And then we're watching the central bankers just talk about higher for longer and about inflation as they continue to fight yesterday's war. Germany looks like it's on the precipice of another recession with obvious complications for all of Europe. I think that if we escape this without a recession, it'll be a miracle. I will have to write a report that hope did triumph over experience, that the U.S. economy, that somehow we've repealed the business cycle. I will write a whole report saying that we've repealed Mother Nature, and that and all the people that were saying, you see, it's interesting, right? Because our industry is populated with optimists, right? Optimists. It's like the the optimist and the pessimist, they go out for a cup of coffee, and the optimist says things can't possibly get any better, and the pessimist says, you know what, I think you're right. So, but our industry is littered with optimists. So
I like that.
the optimists,
And that's stock investors, economists.
but I'm just saying, everybody.
Yeah.
Look, when the Fed's, you go back, in the early '90s. In the early '90s, the Fed slicing rates. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. Back in the early 2000s, the Fed slicing rates. In 2002, the recession was already over. They're still cutting rates to 1% by June of 2003. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. Then you had the same thing in early 2009, as it looked like the banks are going to go bust, Fed's cutting rates. Of course, they did. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. Then, of course, this time, back in March of 2020, the stock market's plunging. Fed opens up its kimono to every asset you can think of. I'm surprised that they weren't buying lithium and uranium, and along with everything else, and slicing rates. Don't fight the Fed. Don't fight the Fed. Don't fight the Fed. So, Jack, you tell me, does anybody tell you don't fight the Fed when rates are on the way up? Nobody says it's like this. Yeah, don't fight the Fed. It's very interesting, right? Don't fight the Fed only works in one direction. But you see, interest rates work with lags in both directions, right? Like, it wasn't, as the Fed was cutting rates, and look, I was loaded for bear back in 2008, but I was telling people back in early 2009 that the Fed's rate moves work in both directions. Next thing you know, the recession ends in the June of 2009. The market bottomed March of 2009. And of course, we're off to the races. And, thanks to the Fed, it works in both directions. To me, I'm going to say it's disingenuous to say that it's different this time. Disingenuous to say that interest rates don't matter and that the Fed policy only works in one direction. There's lags. Let me tell you something, that in the next, all these people saying higher for longer, they will be the first begging for the Fed to cut rates next year, but under totally different economic circumstances. And there is no more fiscal stimulus, by the way. That's over. That's over.
But we're still running huge deficits, right?
Deficits will remain as high, super high, as far as the eye can see. But that is not stimulus. Stimulus is, what does fiscal policy do incrementally to GDP growth? So if you take the fiscal deficit from 1 trillion to 2 trillion, okay, and it was done on the spending side, you've just given an immediate sugar high to the economy, okay? Let's say that you then keep the deficit at $2 trillion for the next 10 years. Incrementally adds nothing. For fiscal policy to be stimulative incrementally, the deficit has to go up each and every year. But it's done. We're not even talking about what happens, now that the hardcore, the hardcore caucus and the, what do they call, the Freedom Caucus?
Yeah.
The Tea Party. Well, we could be facing a government shutdown. The fun and games are over. All the fun and games that Biden did. You see, he was smart. He knew in my first 2 years, I will never, ever be able to do everything I want to do past my first 2 years. So let's do this $2 trillion of giveaways. Let's do the CHIPS Act, the ridiculously oxymoronic Inflation Reduction Act.
If you're trying to get stuff passed, it was a genius naming. If you're trying to name things accurately, maybe not so much.
Yeah, and then what I'm saying, is it different than what like Clinton knew when he got elected in 92? He had 2 years. And he failed at what he wanted to do on healthcare. Obama realized, I got to get this done in my first 2 years. Because when you're president and you got the legislative branch all on side, you got 2 years. Because that's how long this sort of situation between unified executive branch and you got the House and you got the Senate. Same thing with Trump. Trump knew he had 2 years to get his $1 trillion tax cut through, and he did. What happens after that? What happened? Everybody talked about Barack Obama this, Barack Obama that, the big interventionist, and we're gonna, fiscal tightening, and the next thing his last 6 years, there was nothing going on. We didn't have a fiscal stimulus really until Trump took over, and with unified Republicans having control of the agenda for 2 years, they passed $1 trillion tax cut, which had an initial sugar high. It had initial sugar high, but it wasn't sustainable. And that's what I'm talking about. So all this stuff is in the rearview mirror. All the incremental impact of fiscal policy on growth is over. Unless you think that the Democrats are going to take the White House again and they'll sweep the House and the Senate, then we can talk about, well, maybe we'll go back and talk about, a whole bunch of stuff like modern monetary theory again, which everybody was talking about a couple of years ago. But it's very difficult to get fiscal stimulus through when you have divided government. And that's what we have right now. We're going to be facing the prospect of a government shutdown at the end of September. Who's talking about that? You think the Fed's going to be raising rates in that environment? I don't think so. So
end of September government I thought we just got out of that. I thought
no. Well, we got out of the debt ceiling,
yeah,
and then but it only pushed. Well, this is about passing all the appropriation bills, right? Okay. And I think there's still 12 of them to go. This is about next year's budget.
Mm-hmm.
But the overriding point is that the fiscal deficits, yes, they're going to remain very high. They become more structural. The higher interest rates have compounded that. But the incremental impact on growth, on GDP, is in the rearview mirror. And what's staring us in the face are the lags from what the Fed's already done. I don't even know why people can't understand that. The Fed was done in the summer of 2006. Recession starts in the end of 2007. The Fed is done raising rates in the winter of 2000. Recession starts in the winter of 2001. The business cycle is not dead. Admittedly, the people that thought the recession would start already hasn't started yet. But we had some very significant antidotes coming from fiscal policy.
So, David, you make a very compelling case against the no landing argument. Just in a minute, I want to ask you about the soft landing as well as the chance it could be a mild recession, not a deep one. But just I could tell you've done a lot of historical work about a recession starts, a little under 2 years after the last interest rate.
The first hike.
The first hike. Thank you. Is it typical that you have a kind of intermezzo, a contrarian boom as the Fed is raising rates, because people say, oh, the Fed's raising rates, things are got to stop, and the economic activity is going to slow to a halt. But I mean, the economy has been, I would use this word, I'm curious if you would agree, resilient to interest rates so far. I'm not making a projection about that it will continue to be resilient. But do you often find that? I mean, because I think the stock market did rally in 2005 and 6.
When does the bear market start? And you only know that with hindsight. So in 05 and 06, the bear market hadn't started. The stock market peaked on October 9th of 07. You can always go back and take a look. When was the fundamental peak? The fundamental peak this time around was, I think, January 3rd of 2022. So you can't compare this to 06 or 05 because the bear market has already started. I mean, you do not have in 05 and 06 a 35% drawdown in the cyclical components of the stock market, which is what we had last year going into the October lows. We had a 35% drawdown. And it's not unusual to have a reflexive rally. As I quote Bob Farrell, there are 3 stages to every bear market. There's the first leg down, the reflexive rebound, and then the long and drawn out decline to the lows, which maybe that process has already started. I put out on my report a couple of weeks ago, I showed every single market since 1950, showing that what happened this year in terms of the reflexive counter trend rally, we always get that. We even got that. We got that during the Great Recession. We got that during the tech wreck recession. It's not unusual.
Is it always this vigorous though? Where I guess I'm just doing them. It's from the lows in October, the S&P rallied a little over 28% and was within 3% or 5% of the all-time highs, and the Nasdaq was way more. Is that all? It always is that vigorous?
No, it's not always. It's not always, but not unprecedented.
Yeah.
and then you're going to get sucked into the market, and you're going to get your head sliced off. So, I mean, do the math. Do the math. Fundamental lows in the stock market do not occur when the equity risk premium is less than 100 basis points. Normally, you're closer to 400 basis points than 100 basis points. So there's massive mispricing of risk. And where is the benchmark risk-free rate? Now, when it was close to zero back in early 2020, and you're doing your discounted cash flow analysis, you could say, hey, look, this is like a Jack and the Beanstalk. But the risk-free rate is over 5%. And so, if you made 5% last year in treasury bills, I mean, you couldn't last year, but if you did in a year where the market was down 20%, you were a hero. If you made 5% for your clients last year, you were a hero, but you couldn't do that last year in the treasury bill market. But you can do it this year. But you see, because of the fact that you have like 7 or 8 stocks, account for, 3/4 of the return this year. And of course, I'm just an index buyer, so I don't really care. I got concentrated risk. Oh, who cares? Look what the market's doing. 5%. You're up 5% this year, 2023. What a loser you are. 5% in 2022, you're a hero. 2023, because people just look and see what the stock market's doing. But what the stock market's doing today is not necessarily going to be what the stock market's doing by the end of the year or next year. So, sometimes, you look at the stock market and there's a hodgepodge of things that influence it. There's always the fundamentals, earnings revisions, balance sheet quality, the economy. But then there's fund flows, market positioning, there's a technical picture, and there's liquidity, and valuations. And all these things at any moment in time, one of them can dominate more than the other. Sentiment is something I didn't mention. Sentiment, this is a lot of sentiment, and a lot of market positioning. Did the fundamentals really change? Not for me. The New York Fed has a 3 yield curve model that's showing that right now the odds of a recession in the next year are 96%. 96%. The St. Louis Fed has their own. It's at 75%. Are you telling me there's anything out there that is priced for 75% or 96% recession odds? The New York Fed is the one I focus on. It crossed above 70% last November, just by the way, when the Powell yield curve inverted. And I use 70% as a cutoff because there's no returning once you pierce 70% on the New York Fed modified recession model. Once you get above 70%, it is a fait accompli, as they say on the Quebec side of the border. Les jeux sont faits. And so we crossed over 70% in November. And once again, the lags are about 10 to 12 months to the recession, which means that actually the people that were calling for recession just have to be a little more patient. And I think that what camouflaged the situation was all the fiscal stimulus that we had going this year. But you see, that has an expiry date on it. And it's starting actually this month and next month. So it'll be interesting to see. And look, I am more than willing to eat crow, wipe the egg off my face, if we go into next year and the recession signals are not flashing. I will be really surprised, but I won't hide behind a bad call. I'm not changing my call. And I know everybody else is throwing in the towel. They did the same thing back in 2007. Everything in 2007, where's the recession? Where's the recession? Where's the recession? Where's the recession? And the recession came in December of 2007, and the NBER didn't even make the declaration for another 12 months.
And I until in August of 2008, there were still people who were saying that we weren't in a recession, right? After Lehman, it became kind of undeniable.
The consensus. Yeah, well, the thing is that, look, that's what I mean, is that the recession is what causes all the funky things to happen. We just had 3 banks fail, 3 regional banks. Well, it didn't happen in the context of recession, but had in the context of a lot of funky things that were going on during the period of excessive monetary accommodation.
Yes. And it was all due to duration, not credit, but yeah.
Pendulum has swung the other way. So the recession is about declining confidence on Main Street and a pullback in spending. And the pullback in spending then has impacts on incomes, production, and then of course there has to be something that happens that causes the floor to be put under the economy. And then that means the Fed's got to come in and cut interest rates. I continue to come back to, what is this higher for longer? Like, what does it even mean? I guess the Fed's trying to show that they're still flexing their muscles, and that, they still believe somehow their credibility is not fully intact, or they're not convinced the economy is cooling fast enough, or the labor market is building enough excess capacity, or inflation is not falling fast enough, right? All these lagging indicators that they're focused on. Interest rates are cyclical. If you look at the economic cycle, and you look at the rate cycle, and you look at the credit cycle, you look at the market cycle, they're all these centrifugal forces. They are these sine waves that intersect with each other. Interest rates are cyclical. When I hear the higher for longer, it's just I'll tell you, it's just gobbledygook, right? Just gobbledygook. But then why should I listen to a word the Fed says? Why should you, Jack, with all due respect?
Yeah, please.
First question to me is about Powell at Jackson Hole.
Yeah.
The same Jay Powell and the same Fed that told us in the summer of 2021, when they rolled out their dot plots for the end of 2023, that we finished this year with a funds rate at 0.625%. That Fed. Now we're going to finish it at 5.5 or thereabouts. Really? Yep. So all I hear, higher for longer, all the stuff from Powell and the Fed, on Friday, I'll tell you the truth. It was just to me, it was just pure noise. It was just pure noise. All they're telling me is they have no clue. 1 minute, the Fed staff has a recession forecast. The next minute they don't. He tells us, for example, did he talk about his supercore? No, it didn't. Why? Because he doesn't want people to think that he believes inflation is actually going to come down and stay down. 4 months in a row, his favorite indicator that he doesn't talk about, the core X rental measures service sector CPI has been 0.2 or lower 4 months in a row. And over that,
less than 2% annualized. Yeah.
1.6 annualized over that period. But, once again, we don't want the public to think that we actually believe that inflation is going to come down and stay down. They don't want the market to believe that. Okay. They didn't want the market when they unveiled all those 0.6%. Think of how ridiculous that is. They wanted everybody to believe in the summer of 2021. It was not a million years ago, 2 years ago. They wanted everybody to believe we will never raise rates again. We're not raising rates. Oops. Biggest interest rate cycle since 1981. Yep. So seriously, maybe at inflection points, that was an inflection point when rates were at 0, 2021, time to bet against the Fed. And now we're at a new inflection point at the peak after the most aggressive tightening stance since Paul Volcker in 81. Let me ask you a question. Did Volcker, higher for longer? The biggest interest rate slayer of all time was Volcker.
Mm-hmm.
Who was the biggest inflation dragon slayer? Nobody cut rates more than he did. You want to go back and count all the basis points of rate cuts that he implemented? And not just in 1980.
Undoing the hikes, though. Undoing the hikes.
Also in 1985, 86. Biggest interest rate slayer of all time. Higher for longer. So to me, it's just higher for longer. It's a nice slogan. It's a nice slogan. Doesn't mean anything to me. Meanwhile, despite everything they threw, Loretta Mester and Susan Collins, and then they get Richard Fisher, and they get Bullard,
Kaplan.
There's not a camera that Bullard's not going to go in front of. They just got way more to go. They got more to go, and then when they go, they're never going to cut rates again. You see what I'm saying? They said in 2020 and 2021 they were never going to raise rates again. Well, what happened? It was a classic case of like Charlie Brown and Lucy with the football. Now they're saying, they're never going to cut rates again. Do you not see the perfect symmetry here? So I'd be placing bets completely the other way. The market's price, the swaps market's price for the Fed to cut rates 100 basis points next year. It's not enough.
That's next question. How much is enough, and what gives you confidence that it's not a mild recession or even a slowdown that comes just shy of a recession with capital R recession, and that it will be deep?
Why is that? I don't even understand why that's an important question. It's not. So it might not be a deep recession. The mildest recession in history was the tech wreck recession in 2001. So if I told you ahead of that, don't worry, it's going to be a mild recession, you got your head sliced off as an equity investor, not just in the NASDAQ. It was a horrible bear market.
Mm-hmm, mm-hmm.
The Fed had to take the funds rate down from 6.5% down to 1%.
Which a lot of people say was way too low.
Okay, I'm not saying. Look, I'm just saying. Like, what I'm trying to just get back to your question is, like, in answer to your question, I don't mean to be rude.
No.
But I don't care if it's going to be. I'm more cared about. Let's see how deep it's going to be once it starts. We're putting the cart before the horse here. Let's just say the market's not even priced for recession. Why don't we just get to the recession and then see how things play out? I think the risk is that because this Fed is so obtuse and so narrowly focused on its inflation mandate that they are going to be slow, and they've already been too slow. They've already over-tightened, and they're going to be too slow to cut. So I'm not concerned so much about the magnitude. The magnitude will depend on what sort of financial failures we get. I mean, how deep will the credit crunch be? But I don't think anybody's going to handle on the magnitude of the recession, and neither do I. Right now, we're not even people just debating whether there's going to be a recession at all. I'm more concerned about the duration of the recession. I'm more concerned that it's going to last.
Why is that?
Well, that was, you see, when I talked about 2001, that was the problem. That was the problem, is that we had a recession in 2001, and then it was followed by no recovery in 2002. And actually, the lows didn't happen until September, October of 2002. That was already about a year after the recession technically ended.
And with the benefit of hindsight, what was the reason why that recession was so long?
Well, I think once again, the Fed over-tightened as it was fighting the tech bubble, and then it was too slow to cut rates. The Fed didn't start to cut rates until January of 2001. And so they were late. Greenspan had thought, and look, I think Greenspan was a great central banker despite all the flaws, but he had thought it was just going to be an inventory correction. That's what he had thought. And he didn't realize till we got into until 2001 that actually it was not an inventory correction. It was a deflationary detonation of the technology capital stock. Now, I don't want to sit here and, from a glass house and start throwing stones, but, and then of course we had 9/11. And 9/11 cut both ways because it was a big shock. But it's interesting that 9/11 actually, the recession ended 2 months later, the technical aspect of the recession, because of all the stimulus. And then we rolled right over. And then, of course, we had the corporate malfeasance that was going on around WorldCom and Enron. And that, of course, created a crisis of confidence. And that sort of stuff is idiosyncratic risk that you can never really predict. But that's ultimately what triggered us to go down to the lows that fall. Now, the bottom line is that it was still a mild recession, and with or without 9/11, it was still a brutal period for risk assets. So I'm not even so sure. You see, the thing is, if we got actually a big recession and the Fed reacted in kind, we'd get a nice V-shaped recovery. The problem with mild recessions is you don't typically get the V-shaped recovery. The problem I have is that it's not so much with the magnitude of the decline. I'm not too concerned about the magnitude. I'm more concerned about how long the malaise is going to last. Even if we get a mild recession, how long are we going to have a series of low-case W's in terms of what the recovery looks like where, like people talk about, the CHIPS Act, but I mean that's a level shift. That's not something that adds incrementally. People are totally confused when it comes to talking about fiscal policy and the impact it has on year-over-year GDP growth. Does anybody really have there that the cyclically adjusted deficit GDP ratio is going to continue to go up in the next several years? And then we've already reached a point where the debt is so high that the rating agencies are not going to let it happen. And it was so see, there's a constraint. So all the people talking about fiscal this, fiscal that, it's not like in the 1980s when Reagan went through the historic tax cuts and the debt to GDP was like 30%, right? We're in a totally different. Nobody's talking about downgrading, the reserve currency of the world back then. Think about how nutty it is. So there's no more. So I don't see where's the fiscal response going to come in the next recession. We don't have the capacity. And then we have a Fed that's so dogmatic that, now I think they'll be forced to cut rates aggressively and it'll be too late. You're talking about an economy. You see, your question before is going to reverse course because you said, well, the economy is not that interest sensitive.
Mm-hmm.
Well, let's say you're right on that. So what happens when they start to cut rates?
Good point.
You see what's going to happen is the same people saying, the same clowns and stock promoters, and then most of them work at Wall Street banks.
Yeah.
They say the economy, don't worry, it's not interest sensitive anymore. But what happens in the recession when they cut rates? They'll be the first ones to say, don't fight the Fed. But you see, part of it is that we're choking on all these durable goods assets that we all bought. Then of course that went through, and then we went on to going to restaurants and traveling abroad and so on and so forth, and all the experience spending, the anger spending. I'm going to go fly business class to Vegas with my friends, for the week. Well, that's what's going on. But you see the durable goods. What are you going to do for an encore? Are you really going to renovate your house for the second time in 4 years? That's a bit of the problem, is that we are choking on excessive ownership of durable good assets. So,
or if you refied your mortgage at 3.8% in 2020, and now interest rates are at mortgages rates are at 7%. If the Fed cuts 200 basis points and mortgages go to 5%, are you going to refi from 3.8 to 5? No. You're absolutely right that the interest rate sensitivity argument goes both ways for sure.
Really, what was important about the Fitch? You see, people look at the Fitch downgrade and they say, "Oh boy, I got to cut duration of my bond portfolio." Well, look, the U.S. is not going to be. The U.S. government's not defaulting on its debt, okay? And no reserve currency ever has to. The U.S. is not going to default on its debt, and so, Canada's been rated AA plus for God knows how long, and their interest rate structure is lower than it is in the U.S.
Yeah, Japan I think is only single A maybe, and their interest rates are at zero. So.
Yeah, and so, but it does act as a constraint. And what happened actually when we had the what was it? It was the S&P downgrade, right?
2011, yeah.
2011.
Yeah.
The deficit GDP ratio was 8%, and then President Obama was battling a hawkish GOP for years. By the time Trump got elected, that deficit GDP ratio got down to 3%, went from 8 to 3. And without the Fed doing anything, because they had rates pinned at zero, and you could say, well, they're doing QE, but then again, QE was always aimed at generating animal spirits in the stock market. But the 10-year Treasury note yield in that period went down 200 basis points. You had tremendous fiscal drag. That's what I mean. What was the importance of that downgrade in 2011? Was it acted as a constraint. And so you're telling me that we're going to be pushing fiscal stimulus after this last downgrade? No, that source of growth in the economy is over. Just to answer your question though, remember, just to get to neutral. Now the Fed has not changed its estimate of neutral. They have no confidence in that number, but they haven't changed it, and it's 2.5%. So just to get to neutral, they'd have to cut the funds rate 300 basis points just to get rid of the excessive restraint. And the only thing I think that Powell said on Friday that I agreed with is that we are in restrictive mode. Well, just to get to neutral, And maybe they'll have to see more evidence of declining inflation. They'll have to see the labor market loosen up. But just to get to neutral, they'd have to cut rates 300 basis points, let alone move to a net stimulative backdrop.
So the 10-year treasury is at 4.2% now. In this recession scenario of next year, where do you think it goes? And you can tell us at what time horizon.
I think we'll get down to, I think the 10-year note will get down to 3%. And we'll get down on the 2-year note down to something closer to, 2 to 2.5. We have to remember that a couple of things. I am a disciple of Bob Farrell. Okay. Bob Farrell's rule number one is markets tend to revert to the mean over time. The yield curve is only inverted historically 15% of the time. We have to wake up and understand that what's happening with the yield curve is totally abnormal. Anybody who's taken any CFA course or any securities course, I mean, what about the time value of money? The yield curve is positively sloped 85% of the time. And that's normal. And it typically inverts when the Fed has over-tightened policy, which is where we are right now. But this is not a steady state. So if you believe in mean reversion, the question becomes, how will the yield curve mean revert? How will it ultimately revert to its more normal positive slope? Will it happen because the back end of the curve, yields shoot up? And if that's your view, why hasn't it happened already? What is already going to happen?
And that's been very rare historically, right?
Yeah, well, at this stage of the cycle, and after the Fed raises rates 500 basis points, the back end, the inflation genie's been put back in the bottle. I mean, look at the Baltic Dry Index, for crying out loud. It's down 80% from the peak. And so the curve is going to, this time next year, be positively sloped. I think traditionally, say, 2s, 10s is usually 100 to 150 basis points. So I think that, you're probably down to 2.5% of the 2-year note. You're 3 to 3.5 on the 10-year note. I think those are levels, I think, in the next year in the context of recession and declining inflation. I said before, the San Fran Fed puts out the best research. If they are anywhere in the ballpark on rents, inflation is going to be, if not 1%, 0.5%. The Fed's not going to be cutting rates. And like I said, just to get to neutral, they'd have to go 300 basis points. And I think that they'll ultimately go below 2.5% because I think the economy is going to need the help. I know that it's not evident right now. Everybody is talking about consumer resilience and economic resilience. I've never made it a point of forecasting what today's headlines are saying. I spend my life forecasting what are the headlines going to say 6 and 12 months from now. And it will be saying that we have entered into a default cycle. We're going to have a loosening up in the labor market on higher unemployment, which is what the Fed wants. The Fed gets what it wants. Interest rates will we won't be talking about higher for longer anymore. And I think we'll be talking about the fact that the recession came. It came late, but it came. I can't tell you, the same people that today threw in the towel on the recession call did the same thing in 2007. And believe me, when my nickname at Merrill Lynch was a skunk at the picnic. I had no friends. But I stuck to my guns because I'll just tell you why. I do not believe in new eras. I don't believe in new eras. I don't believe the business cycle has been repealed. And I believe that interest rates will always matter for asset prices, especially long duration asset prices, and for the economy, especially a credit-driven economy like the United States. It's preposterous to say. Now, we can always talk about that there are antidotes, and fiscal policy, the lagged impacts of everything I talked about, helped out this year, keep the economy above board, not to be repeated. And so I will keep an open mind. I've been in this business long enough to know that you don't put all your eggs in one basket, and there is no such thing as a sure thing. I'm willing to give it about 6 months. If my call doesn't prove prescient by then I will be the one screaming uncle.
Just because something hasn't happened yet doesn't mean it's going to happen. You're absolutely right. And before I ask my final question, so people can find you on Twitter at EconGuyRosie, and your research Rosenberg Research and Associates. My final question for you is, do you think that the global manufacturing cycle has bottomed or is about to bottom? Because if we enter a recession, if the US enters a recession, but the global manufacturing cycle is going to, come out of a trough, that would mitigate a lot of the damage to the global economy. But if not, then that could be a lot more serious.
No, I'm waiting for it. Not seeing it in the data. We just put out a report on. We have a whole global PMI heat map, and it's not showing that we've hit bottom yet on the manufacturing side. And really, when you think about it, how can it? When you look at how weak things have become in Europe and also in China, and then there's all sorts of impacts through the trade channels. Looking at the orders to inventories data, for example, that ratio not giving me a signal that we've hit bottom yet on the manufacturing side. I know that we got to differentiate between the construction of manufacturing facilities to facilitate bringing, say, chip production home, things along those lines. That again has to be amortized over long periods of time. Then the question is going to be, once you build the plant, who are you going to sell the stuff to? And that's so the PMI data, the manufacturing production data, they're not measuring the fact that we might be adding manufacturing plant capacity, but it's measuring demand in the industrial sector. And it's still weak, and I'm not getting a pulse right now telling me that it's hit bottom.
Interesting. And then in the US, do you have a view on where the unemployment rate will peak? I know in 2009 or 2010, it peaked at a very high level, but it is possible that, okay, yes, US enters a recession, but still on a secular level, there's a tight labor market. So the, unemployment rate peaks at, 5%, 6%. What do you think about that?
Well, it's because, again, because of all the COVID distortions, it's really hard to make book as to where it's going to peak out at. And there's no doubt that companies have been hoarding labor. And this all came out of the U.S. response, the government's response to COVID. The government paid people for years to not work, extended and expanded unemployment insurance well after the economy reopened. And so people chose not to work. But a lot of people were in the lower skilled, lower pay sectors of the economy. You're getting paid more not to work than go back to your old job. That's why a lot of these, say, low value add service sectors had such a horrible experience trying to get people back to work in the last couple of years. Of course, nothing works better than just raising wages and bringing people online. And then, of course, we had the whole period where the quit rate became the Fed's favorite indicator because everybody was jumping around, but jumping around really mostly in the leisure hospitality industry. And that's really what we're talking about. So it's interesting that we've seen erosion in a lot of labor market indicators, but you're not seeing that being picked up in the jobless claim numbers. Like historically, if we're talking about a real recession, jobless claims would be close to 300,000, not 230,000. But you see, all the claims numbers tell you is about what's happening in terms of firings and pink slips. They don't tell you much about what's happening with hirings. So we know the hiring rate has come way down, but the firing rate's doing next to nothing. So it's an interesting dichotomy, but what have companies been doing? Companies have been doing two things. They've been pushing people from full-time to part-time. I mean, in the past 4 months, I think full-time employment's down 65,000 and part-time is up well over 200,000. So you're seeing this shift from full-time to part-time, and that's from the household survey. But we also know from the payroll survey that there's been no growth in the work week all year long. In fact, companies in the past 6 months have cut the work week. So the work week's going down. So companies are finding ways to rationalize on labor without actually laying people off. The question is, and how long can you do that? But that's something else that we have to consider is that, when you get the unemployment rate numbers, that comes from the household survey, doesn't come from the payroll survey. But the Bureau of Labor Statistics naturally treat a full-time job the same as a part-time job. So we've already lost full-time workers. They've been furloughed into part-time work. But when you adjust for things like that, and you adjust for, say, the surge we're seeing in multiple job holders, this comes down to, why are we seeing these strains? Look, Jack, when you stop paying your credit card bill as an American shopper, I mean, things can't be that good.
Yeah.
And when you're seeing though a boom right now, the past 4 months in particular, and the number of people taking on more than one job. Let me ask you a question. Do you see that when we're seeing a strong economy, do people actually take on more than one job? Or is it when things are pretty tough? And so you're seeing a proliferation right now of people taking on more than one job. That's a countercyclical indicator. But when you take all this stuff together, the decline of the work week, the shift to part-time, multiple job holders, and you factor that into the unemployment rate, it's actually at 4% right now, not 3.5%.
So still low, but not as low.
Right. That's exactly right. There's more slack than meets the eye. And so what's happening is that companies are finding different ways to economize on labor than just firing people. And they don't want to fire people, not because they become, the most generous business owners on earth, but for fear of, I lose this person again, will I find them again in the next cycle? So there is labor market hoarding going on. The question is, are these corporate CEOs like the little boy with the finger in the dike, and then at some point they got to pull the finger, or basically the unemployment rate ultimately does not go up as much because of the way that it's constructed, but you still get labor force contraction.
So by go up as much, that would be what, 5.5%, 6%?
That would be a big move, right? From 3.5. I mean, that would be, if you're talking about a recession, that would be a big recession. You're talking 6%.
Oh, okay.
It could end up being that way. The worst it gets is 4.5 to 5. That could be, and what I'm saying is that, but when you really adjust it for more holistically for what's happened in the labor market, like for example, the work week. The work week is a leading indicator, right? It's the work week is the only, well, along with jobless claims, but the work week out of the official data is the only leading indicator. The work week is because companies typically, they cut hours first and then they cut bodies next.
And so I think just looking at that unadjusted unemployment rate, I think at an unemployment rate peaking at 4.5% in a recession, that would be pretty close to the lowest peak during a recession, right? In history, pretty close, right?
Yeah, absolutely. But look, in that sense, it's because of what happened with COVID and one of these post-COVID realities in terms of how it's influenced how companies want to reassemble the decks. Is it normal to be in an economy that people call resilient, where there's been like no growth in the index of aggregate hours worked since January? So the past 6 months, no growth in the overall supply of labor. So you look at non-farm payrolls. Yeah, but you don't ask, well, how much of those are part-time jobs? Oh, look at non-farm payrolls, but you don't ask the question, well, but what's happening? So we're hiring these people and then we're telling them to work half days. What does that say about the overall economy? So that's really what I'm talking about, that it could be one of these, I said I'm not a new era person. I guess maybe I got to put an asterisk next to that maybe the labor market has shifted in that regard, because of the painful memory most business owners have about losing labor and then not being able to find them again. However, it could be that we go through this and it's a mild recession, which 4.5 to 5% unemployment would signify in any event. To me, the bigger question is going to be, how do we get out of it? When I talk about this, nobody believes it. They're still stuck with a higher for longer and all the inflation. Nobody could believe in 1989 or 1990 that we'd ultimately get down the funds rate from 9 7/8 down to 3%. Down to 3% by 1993. I lived through that. Nobody could believe the funds rate would go 6.5%, in early 2000, that we finished the cycle at 1%. Who believed that? 1% by June of 03. And then in 07, as we got what did we get to in the funds rate? 5.25. Same thing. In fact, the Fed was threatening to raise rates in the summer of 08, and Trichet ended up raising rates in the summer of 08. Great timing. Higher for longer, inflation, 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 higher for longer. Who thought we were going to finish that cycle at zero with QE? Who knew what QE was? I used to walk around the desk, the desk at Merrill, explaining to them what the QE was back in late 2008. Now kindergarten children know what quantitative easing is.
I take it you're bullish on bonds and not terribly bullish on stocks. That is to say, bearish. How bearish are you on stocks?
I think that the stock market is going to need the Fed's help, but then the stock market's going to need the bond market's help. So I think the math takes you down to like 3.5 on the 10-year note, and takes you down back to like 3,400 or so on the S&P. And that's the math that gets you to an equity risk premium that you can build on for the next bull market. Keeping in mind about the timing that bull markets start, fundamental bull markets start 70% of the way into the Fed easing cycle. They haven't even eased yet. And when the yield curve 2s10s is 140 basis points, well, we're still like inverted by what, 70 basis points, whatever that number is. It changes by the day. So everybody chased this year's rally, and it was a nice bear market rally, which is what it was. And we always see them. Some of the biggest rallies of all time happen in the context of bear markets. If I added you up all the rally points in late 07, 08, and 09, if I add you all the rally points, the bear market was October 07 to March of 09, your head would spin over the number of rally points that we had along the way. We had multiple double-digit gains in the S&P 500 in that whole awful Great Recession, financial crisis. So, you always want to have your historian hat on, because, things don't always play out the same, but there are recurring patterns.
Well, Dave, thanks so much for being generous with your time and insights. I really appreciate it. And thank you, everyone, for watching.
Take care.